Um, Welcome to our CalSTRS and CalPERS webinar. Thank you for taking some time to learn about such an important topic that will help you prepare and shape your future retirement. Wanted to first wish all of you a happy Teacher Appreciation Month, whether you're a teacher, support teachers by keeping their students fed, keeping the schools clean, taking care of students' emotional health. You all play a very vital role in educating our youth, so thank you so much. My name is Tori Gutierrez, and with me today I have my partner, Alex Sierra. Alex and I are financial advisors who specifically work with teachers and public service employees. For over a year now, we've been meeting with teachers virtually to help them navigate their retirement decisions. As many of you may have experienced, there has been a spike in teachers retiring, especially this year. So knowing how your pension works before actually doing so is very, very important. A few resources before we get started. We have our website. If you want to write that down, the URL is at the bottom, where you went to RSVP for this webinar as well. On there, you can schedule a meeting with either myself or Alex, read blog posts that we write ourselves, watch our educational videos, and much more. We specifically have a teachers tab as well, with resources for our teachers. And the bright yellow buttons are our schedule a meeting links, where you can access our schedules to set up a virtual meeting with either myself or Alex. And there. And, go ahead and just click schedule with Tori or Alex, and it will take you to our calendars. And there will be an opportunity at the end of this webinar to request a consultation with either of us. And last but not least, we have our YouTube page where I have a series dedicated to California public school teachers, 2 to 3 minute videos on some of the most relevant topics for teachers. So check that out if you'd like. And without further ado, let's get into the good stuff. And I'll turn this over to Alex. Okay, go for it.
All right. So thanks, Tori. Thanks for that great intro. So we'll go ahead and get started with the meat of our presentation today. So today we're going to be covering the 2 largest pension systems in the state of California. So one is the California Public Employees Retirement System, or CalPERS for short, and the other is the California State Teachers Retirement System, or CalSTRS for short. Typically, teachers are the ones who have the CalSTRS pension, and other school employees are the ones who have the CalPERS pension, but there are some exceptions to that as well. There's definitely some key differences between the different pension systems that we're going to be reviewing, but in general, there's actually a lot more similarities between the 2 pensions. A lot of the same concepts apply across both of them. So one similarity, and this one's pretty basic, is that they're both pension systems, right? So what that means is that employees, while working, are making contributions into the pension system. These contributions go into a large professionally managed fund, and then later down the road, when employees enter retirement, they begin receiving distributions from that pension fund based off of a specific equation determining how much they get from the pension. So both CalSTRS and CalPERS work that way. All right, so today we'll be doing more of kind of like a high level overview of the 2 pension systems. So if you're interested and you want to see how these numbers and you want to see how these concepts apply to your own individual situation, we'd be happy to schedule a virtual meeting to review that with you. So going through a brief kind of outline of what we're going to be going through today. So these are some of the key areas to review regarding your retirement benefits. So we'll be reviewing your eligibility for retirement. We'll review the difference between the pension for those hired pre-2013 and those hired post-2013. We'll review some of the most common terms used when talking about retirement for teachers. We'll look at how to estimate your benefit. We'll look at the different income options that the pension systems provide, and then we'll also discuss how Social Security can affect your pension payment. So a lot to get through today. So we'll start with the first thing on that list, which is eligibility rules for retirement. So this helps us answer the question, who is eligible for retirement? So this is the time when you are considered vested in the pension and therefore entitled to at least some retirement benefit. For CalPERS, normal retirement starts at age 50, as long as you have at least 5 years of service credits. And that's going to be for those hired pre-2013. For those hired post-2013, normal retirement starts a little bit later at age 52, as long as you have at least 5 years of service. For CalSTRS, normal retirement age starts at 50, but you're going to have at least 30 years of service, or age 55 with at least 5 years of service. And this is, again, for those hired pre-2013. For those hired post-2013, the normal retirement age starts at age 55 with at least 5 years of service. So there's certain special situation where the pension can make an exception, but not typically. So it's important to remember that just because you may be eligible for retirement, that doesn't necessarily mean that it's the right time for retirement. This is just the first year, essentially, you become eligible for some sort of benefit. So next we'll look at how to estimate your contributions. So many don't even realize or don't know exactly how much they're contributing to the pension on a regular basis because it comes out of your paycheck automatically, but it is relatively substantial. And in addition to your contribution, this is also where your district provides a match and contributes to the pension on your behalf. The equal amount that you're also contributing. So for CalPERS, members contribute 7% of their pay. So for example, for somebody whose annual pay was $60,000 for a year, that their total contribution for that year would be $4,200. For CalSTRS, you can see that the percentage has changed throughout the years. However, it's currently fixed at 10.25%. So for example, if now your pay is $60,000, your contribution for the year would be $6,150. All right, so now that we've talked about eligibility and estimating your contributions, we'll start discussing how to calculate your payout. So that's probably, what everybody is most excited to see is how much will I be able to get from the pension when I retire. So the equation on here, if you're taking notes, I would probably say is the most important takeaway item from today. So the calculation, the equation is going to be the same whether you have CalPERS or you have CalSTRS. It's a simple 3-part equation. So it's service credits times age factor times final compensation. And in order to calculate your benefit, all you have to do is multiply those 3 factors together. So in order to get kind of a better understanding, we'll go through each of these different factors and explain kind of each one by one. So we'll start with the first part of the equation, which is service credits. So in general, for service credits, 1 full-time year of service will get you 1 full service credit. If you've worked part-time, you may get partial service credits for those part-time years of working. So say you worked approximately 50% of normal hours, you might get half a service credit for the year. When you retire, if you have significant unused sick leave, you can also turn those in for additional service credits. Also, if you work additional duties like summer school or coaching, so you're working more than a full-time load, you can actually still only earn a maximum of 1 service credit per year. So the maximum you can earn is 1 service credit per year. Part-time, you can earn partial service credits. Back in the day, you also used to be able to use your savings to buy additional service credits when you're preparing for retirement. However, they've done away with that, and you can only purchase service credits if at one point you cashed out your pension and you were trying to buy back old service credits. So you can't buy new service credits, but you do still maintain the ability to buy old service credits if you cashed out. You can easily estimate your amount of service credits if you know how many full-time years you've worked. However, the only place to see the exact amount of service credits you have is either through your pension's statements that they send out or on the pension's website. So taking a look at your statement for both systems, you should receive a copy of your statement every year. You can also at any point in time access your statements online. For CalPERS, you can just Google My CalPERS, go to that site, and then download your most recent statement. And on there, it should be pretty simple. You can see the picture there, but pretty simple to locate your amount of service credits. For CalSTRS, same thing. You can Google My CalSTRS, go to that site, download your most recent statement, and then pretty easily locate your service credits there. One other note for the CalSTRS members out there, downloading your statement or looking at your statement is also going to be the best way for you to check the balance of your defined benefit supplement, which is an additional cash value account inside of your pension that we'll discuss a little bit later today. All right, so we talked about service credits, which was the first part of the equation. Now we're going to take a look at the second part of the equation, which is age factor. So these age factor tables on the slides are from the CalPERS and CalSTRS handbooks, respectively. So if you ever need to look up the age factor table, it's in your most recent handbook. The age factor table is different depending on when you were hired. So the ones that we have on the screen now are for those hired pre-2013. On the next slide, we have the ones for those hired after 2013. And we'll just notice that those hired after 2013 will have to work a little bit longer to get the same age factor as those hired pre-2013. So looking at the charts here, starting with the CalPERS side, you can see the name of the pension for those hired pre-2013 is the 2% at age 55. So that's kind of the name of the CalPERS pension that those of you hired pre-2013 have. You can see that the youngest age factor on there is 50, where it's 1.1%, and the largest is at age 63, and it maxes out at 2.5%. So going through a quick example, if somebody is age 60 and they have 28 years of service credit and a final compensation of $60,000, we would plug the numbers into that three-part equation. So it'd be 28 times 2.31 times 60,000, which comes out to a final compensation of over $38,000 per year there. On the CalSTRS side, pretty similar. The lowest age is also age 50, and it's also 1.1%. And then the maximum is at age 63. And you can see that the max is 2.4%, just slightly smaller than the maximum over there with the CalPERS. And I'm not going to run through that example because it works the same way. Just plug those numbers into that three-part equation. So these we'll take a moment to look at are the age factor table for those hired post 2013. So these are the newer employees. So for those on the CalPERS side, the name of the pension is now 2% at age 62. And we can see that now the minimum age starts at 52. So there's nothing even on there for age 50. And the maximum age has been pushed up to age 67. And it's still at 2.5%. But interesting to note that if we were looking at the pre-2013, it maxed out at 63. So now it maxes out at 67, which just goes to the point that newer employees will have to work just a bit longer to get the same retirement benefits. On the CalSTRS side, the story is pretty much the same. The minimum on that table is now at age 55, which is 1.16%. And then the maximum is at 65, which is at 2.4%. So same maximum of 2.4%, but on the pre-2013, that was at age 63, and now it's at age 65. So we'll have to work a bit longer to get the same benefits. All right, so we've looked at the first two parts of the equation. So that's service credits and age factor. The third and final factor in the equation is called final compensation. Interesting to just take note that final compensation does not always mean your last compensation, despite what the term kind of insinuates. It actually, we'll go through it on the slide, for CalPERS, means your highest consecutive 12 months of compensation. So typically, that will be your final compensation if your last year is your highest year of earnings. But for some that have maybe gone to higher paying roles, stepped back to lower paying roles, or jumped around in other ways, the final compensation number might not actually be their last compensation. For CalSTRS, your final compensation is going to depend on your years of service. So if you have over 25 years of service when you retire, they will plug in your highest annual salary for your final compensation. However, if you have less than 25 years of service, they'll instead take the average of your highest 3 consecutive years of earnings. So that 25 is often somewhat of a magic number for teachers' retirement. All right, so there's one additional benefit to know about, and this one is, it's called the career factor, and this is only going to apply for those that have CalSTRS and were hired pre-2013. So it was additional benefit for teachers before 2013, and the career factor says that with 30 years of service credits, you will get an additional 0.2% added to your age factor. So all the implication of that is that if this applies to you, when we were looking at that age factor chart a couple slides back, you would add in just a minuscule 0.2%. So even though it seems small, it can make a significant difference. One thing to note, however, is that the maximum age factor is still going to be 2.4%. So if you are retiring at age 63 and the age factor there is already 2.4%, even if you have 30 years of service, they're not going to give you that additional 0.2%. So just note that as well. So just running through a quick example here. So this is a member that is 62 years old with 30 years of service credit and a final compensation of $60,000. So we would take the 30 service credits, and then we would plug in 2.4% for the age factor. So the way we get that is by going to the age factor table where it would say 2.27%. We would add the 0.2. That would take us over 2.4%, which we can't do. So that's where they stop you at 2.4%. We take those two numbers, multiply them by 60,000, the final compensation, and that comes out to a benefit of $43,000 per year. All right, so we've gone through all the factors of the equation just to kind of let that hit home. If you want to estimate your pension payout, all you have to do is take the amount of service credits that you expect to have at retirement. So it's basically how many you have right now, plus however many years you have to go until retirement. So that was what you would plug in for service credits. Then you would go to the age factor table and you would find the age factor associated with the age you want to retire. And you would start by multiplying those two numbers together. Those two numbers will give you the percentage of your final compensation that you can expect at retirement. And I'd say that's the most important number to arrive at, because your final compensation, especially if you have lots of years to go until retirement, is probably going to change with raises, cost of living adjustments, etc. But using those first two factors of the equation, you can get a solid idea of the percentage of your income that you'll be able to replace. And if you want to multiply that equation out to get a numerical estimate, you would just take that percentage, multiply it by your expected final compensation, and that would be what you can expect from your CalSTRS pension. So again, our team has calculators that can help run estimates for all of you at various ages, but you can also do a quick estimation on your own using those factors. All right, so we've gone through the equation, and now we're going to start looking at the different payment options that you have when you start receiving your benefit. So other than deciding when to retire, deciding which survivor benefit option to take is probably the second most important decision that you'll make when it comes to retirement planning. And really the reason is once you pick an option and retire, you can't go back and change the survivor benefit option that you picked. So it's kind of an important decision to make. And once you make it, it's final. So far, the equation that we've reviewed is the one that calculates the unmodified allowance for CalPERS. This is the option that pays your retirement benefit out to you for the rest of your life. The catch here is that it will only pay the benefit out to you. So if you pass away, nothing would go to any survivors or spouses, etc. So if you're retiring as a single individual, it's typically a no-brainer. You would choose that option because the unmodified allowance will give you the highest benefit. However, if you're married or have other dependents, you might wish to have your payment continue to your spouse or your dependent, even if you pass away. And this is especially important with the risk of you passing away early, because your spouse may have to live for a long time in retirement without your income. The pensions do provide some survivor benefit options to help deal with this. So with these various options, pretty much the way that they work is the more protection that the option provides to your spouse, the smaller the benefit that you see while you're still alive. For CalPERS, the most common survivor benefit options are option 1, option 2, and option 3. Option 1 is a lump sum payment of the remaining member contributions that's payable to the beneficiary after death. So if the retiree passes away, there would be a lump sum of whatever is remaining of what they contribute to the pension that goes to the beneficiary. Option 2 is the 100% option, where your beneficiary would receive 100% of the monthly benefit that you're receiving after you pass away for the rest of their life as well. And then option 3 is the 50% option, where your beneficiary would receive 50% of the monthly benefit that you're receiving, so half of your benefit for the rest of their life there. So to help kind of with understanding there, we'll go through an example. So in this example, this member is age 60, has 28 years of service credit, and a $60,000 final compensation. Based off of the three-part equation, we can quickly calculate that the unmodified allowance is $3,234 per month. So that's how much, if you were single, and you took the unmodified allowance, how much you would get on a monthly basis. And as you can see, looking at all of the other options on there, that's going to be the highest monthly amount because it's only for you. Option 1, which is the lump sum option, has a monthly benefit of $3,135. So you can see that's approximately $100 less per month to you, so that you can pass down a lump sum to your beneficiary if you pass away. Option 2, the 100% option, comes out to $2,800 a month. So in this example, you would receive approximately $400 a month less from your pension. But if you passed away, your beneficiary would continue to receive that $2,800 a month for the rest of their life. Option 3 is the 50% option. You would get a monthly benefit of $3,000 a month. And what you can see there is that is only about $200 less than what the unmodified allowance is. So it costs a little bit less for option 3. But if you were to pass away, your beneficiary would only receive half of that benefit, which is about $1,500 a month for the rest of their life. So the same concept for survivor benefit options also applies across the board for CalSTRS. The three-part equation that we've been going through calculates what's called the member-only benefit for CalSTRS, which is the payment option that goes to you and you only. CalSTRS provides a few survivor benefit options as well. The most common are the 100% option, the 75% option, and the 50% option. To understand these options, we'll just go through the example. So in this example here, same member, age 60, 28 years of service, $60,000 final compensation. The equation we calculate comes out to $2,800 a month. So that is the member-only benefit. If that person elects the 100% option, they would only receive $2,500 a month. So about a $300 deduction. But if they pass away, that $2,500 would continue to their spouse. The 75% option, you can see, costs you a little bit less. So you would get almost $2,600 a month with this option. And then your beneficiary would receive 75% of that at around $1,900 a month. And then so on and so forth with the 50% option, costs you a little bit less, but your beneficiary would only receive 50% of your benefits. So before finalizing any survivor benefit option that you pick, because like I mentioned, it's a very important decision and it's also one decision that's final, it's important to weigh the benefits and the costs of each survivor benefit option. If you do choose a survivor benefit option, essentially what you're doing is purchasing insurance for your pension from the state, right? And one thing to remember is that because this is a benefit that the state has to offer to everyone at the same rate, regardless of health, on average, this can often be an expensive way to protect your pension. So for some, especially for those that are healthy, it may be cheaper and more efficient to try to protect your pension through private life insurance or another similar vehicle out there on the private market, since they can probably more accurately price it if you are healthy and you can get there for a better deal. So this concept is called pension maximization. And basically what it means is it involves using private life insurance to protect your pension, and then with your pension taking the member-only option or the biggest option so that you're maximizing your pension. So this is a concept that only applies to some people, but our team can help review your numbers and also request quotes from various insurance companies to see if this option makes more sense for you. So just make sure to bring up survivor benefit options or pension maximization when you're talking to your advisor. All right. So once you take your benefit, it won't just be a constant amount over time. You will actually see your benefit continue to grow. Both pensions do provide some inflation adjustments. This is also known as a COLA, or a cost of living adjustment. For CalPERS, they have a maximum inflation adjustment of 2%, and they base that on the CPI, Consumer Price Index. So it's supposed to line up with inflation, and their goal is to maintain at least 75% of purchasing power at all times. And then for CalSTRS, they have a non-compounding 2% inflation adjustment, and their goal is to maintain at least 85% of purchasing power. Another account that can help battle the effects of inflation is the defined benefit supplement. And this is something that applies, again, only for CalSTRS members. But the defined benefit supplement is an additional cash value retirement account that you can access once you retire. If you've worked for the district for a long time, or maybe you've worked a lot of extra time, summer school, coaching, etc., you may have a significant amount of money inside of your defined benefit supplement. And upon retirement, you'll have some options of what you're going to do with that. So you can either annuitize the defined benefit supplement, so take it in the form of monthly income, and then it would just add a little bit to your monthly income from your regular CalSTRS account. You also have the ability to cash it out at that time, or you can do what most people do, is they do a rollover into an IRA so that the money can continue to grow and you can access it later down the road whenever you need it. So if you have a defined benefit supplement and need assistance weighing your option, that's one area that our team can definitely help in there. So I'm going to go ahead and pass this back to Tori. She's going to review how Social Security can interact with the CalPERS and CalSTRS pensions. So take it away.
Alrighty, so if you are contributing to CalPERS and you work for the school district, you also contribute to Social Security. So you'll be eligible for Social Security. To qualify, you must have at least 40 credits or quarters, which translates to 10 years of full-time work. If you're contributing to to CalSTRS, you are not contributing to Social Security. However, if you have contributed to Social Security in the past, you may be impacted by what's called the windfall elimination provision, or the WEP. If you have a spouse who will be getting Social Security, you may be impacted by the GPO, or the government pension offset, when it comes to your spousal benefit, your survivor benefit, or ex-spousal or ex-survivor benefit. So more on these later. We'll go through a couple of examples with that. But first, want to just go through the basics of Social Security so we can determine how much you'll potentially get at your full retirement age. So what is your full retirement age? The year that you were born will help us to figure out when you will receive 100% of your Social Security benefit. So those who were born before 1954 will receive their benefits, their full benefits, at 66. Those born after 1960 will receive their full benefits at age 67. And those born in between those years will receive some variation of 66 and some months. So go ahead and identify the year that you were born and write down your full retirement age amount, age, and this will be important later. So your full retirement age is the age that you can get 100% of your benefit. You can, however, apply for your benefits as early as age 62. And if you do, you will not receive 100% of your benefit, but you'll get a smaller percentage. So go ahead and locate your full retirement age. And for example, if your full retirement age is 66 and you apply at age 62, then you will get 75% of what your benefit would be at age 66. If you apply for your Social Security at age 62 and your full retirement age is 67, then you'll get 70% of what you would get at your full benefit age of 67. And what if you apply after your full retirement age? So the federal government does incentivize you to wait a little bit longer to start claiming. And for every year that you wait, you get an 8% delayed credit for each of those years. So if you have a full retirement age of 66, sorry, 1 second.
Yep.
Okay, there we go. If you have a full retirement age of 66 and you wait until age 70 to claim your Social Security, you'll actually get 132% of your full retirement age benefit. If your full retirement age is 67, you'll get 124% of your benefit at age 70. So why delay? So if you get more money sooner, if you file at 62, why would you wait? So first, you get a higher percentage the longer that you wait up until age 70. And second, starting with a bigger benefit will compound with cost of living increases later. So if you look at, had this person claimed at age 62, by age 70, that $2,000 a month benefit would be $2,588. If you waited until age 70, that benefit by age 70 will be $4,554 a month. And if you look 10 years down the line at age 80, if you claimed at age 62, you'd be getting $3,378 a month. But if you had waited until age 70, that benefit will have grown at the same age to just under $6,000 a month. So kind of really big long-term impacts of waiting. Oftentimes we get the question, so when will it be worth it for me to wait? Oftentimes a break-even age, AKA what age is it worth me waiting? This is where a break-even analysis is very important. Some people can't wait either due to health reasons, shorter life expectancy, no other sources of income, etc. All situations are different, but if you want to see at what age do I have to live to make it worth waiting, that's an analysis that Alex and I are able to do as well. So the windfall elimination provision. So this impacts those who have added to CalSTRS and who will be receiving a CalSTRS benefit in retirement, and they're eligible for Social Security from a different job. So on the left-hand side is a chart that shows the amount of reduction from somebody's Social Security benefit on the right side compared to the years of substantial earnings. So it depends on how many years of substantial earnings with how much you're going to be impacted. But we'll go through an example just to get a better understanding of this. So Sonia Garcia is 65 years old. Her Social Security benefit at her full retirement age 66 is $1,000 a month. But she will also be receiving CalSTRS, so she will be impacted by the windfall elimination provision. Sonia has 15 years of substantial earnings. So if we look at this chart, so substantial earnings just means that you made a certain amount and added to Social Security. And there's a chart that we have to cross-reference to determine if it's a substantial earnings year. But assuming that she has 15 years of substantial earnings, you can look at the chart on the left-hand side and see that with 20 years of substantial earnings or less, which is what will be applied to Sonia, $498 will be deducted from her Social Security benefit to determine how much she'll actually get from Social Security. So what will Sonia's Social Security benefit be after the windfall elimination provision? Just take $1,000 a month minus the reduction, $498, and that gives you what she'll be receiving from Social Security after the windfall elimination provision. So $502 per month instead of $1,000. So nearly halved in that instance. With spousal benefits, someone might also be impacted by what's called the government pension offset. But first, let's go through what spousal benefits are. So a spousal benefit is half of the primary worker's Social Security benefit if started at full retirement age. So let's go through an example to just understand what this means numbers wise. So Mary's benefit, so Mary is the breadwinner between her and her husband, Jacob. Mary's benefit at full retirement age is $2,000 a month. And Jacob, her spouse, his benefit at full retirement age is $800 a month. If Mary applies at her full retirement age for her Social Security benefit, Jacob's spousal benefit will be half of Mary's, so $1,000 per month. Now, this might be impacted. Jacob may not get this spousal benefit if he has a CalSTRS pension. So let's go to an example that might be relevant to many of you that have spouses who have added to Social Security and are in the private sector. So same example of this couple, Mary and Jacob. They're married and both are 66 years old. Mary's Social Security benefit at her full retirement age is $2,000 a month. And the spousal benefit, again, is half of the higher income spouse's benefit at full retirement age. So $1,000 a month. And let's say Jacob is a teacher. He has a pension from a non-Social Security employer, AKA CalSTRS, that he's going to be receiving $3,000 a month from. So what will Jacob's benefit be after the government pension offset is applied? So the way that the federal government calculates this is they take 2/3 of the pension, so 2/3 times 3,000, which gives us $2,000. We then subtract the $2,000 from Jacob's spousal benefit. So 1,000 minus 2,000 is negative 1,000. So Jacob, thank goodness, will not owe $1,000 a month, but he just won't be eligible for a spousal or a survivor benefit. So just going into your retirement, many people kind of expect these things like a spousal benefit or a survivor benefit to just be applicable to them, but with the non-Social Security paying employer, these are two things that we want to make sure that we're taking into consideration. So that's all I have on Social Security. There are many different situations and yours is unique to you, so please consult a professional or one of us to help you determine how many or which strategies that you will be implementing.
Sorry about that. All right. So for most people, your pension and Social Security alone will probably not be enough to fund all of your retirement expenses. I'd say this is especially true for those that live in a high cost of living area, like many of us here in Southern California. So to save additionally for retirement, there are a few different supplemental retirement programs. The most common type of account at the school districts is the 403B. 403B is a pre-tax, tax-deferred retirement account that you add to via payroll deduction. And with the 403B, you're able to choose from a variety of providers that your district has approved. Most districts will also have a 457B program, but which is also a pre-tax, tax-deferred retirement account, but you will usually only have one provider that you're able to choose from if you decide to go that route. In addition, for individuals, there are traditional IRAs and Roth IRAs. IRA stands for individual retirement accounts. Traditional IRAs are pre-tax, tax-deferred accounts that work the same way from a tax perspective as a 403B and also similar to a 457. There's also Roth IRAs, which have a different tax treatment. When you have a Roth IRA, you add to that on an after-tax basis, so it doesn't save you money on taxes today. But once your money's inside of the Roth IRA, it grows 100% tax-free, and your distributions later down the road are tax-free as well. So that's an additional way that has a little bit of a different tax treatment. Some districts out there also have the option to start up a Roth 403B, which is similar to a Roth IRA, but you can add to it through payroll deduction. But all districts are different on their rules about Roth 403Bs, so our team can help you research if a Roth 403B might be an option for you or not. If you already have a supplemental retirement account, our team can help you review your investment portfolio and make sure that you're set up for long-term success. If you still need to start up a supplemental retirement account, our team can walk you through all of your different options and help you decide which type of account makes the most sense for your particular situation. All right. Okay, so that pretty much concludes the main part of our presentation, kind of the meat of our presentation. I wanted to go ahead and thank you all for your engagement today and for taking some time out of your busy days to touch up on your pension knowledge. Just wanted to provide some final reminders that our team is available for virtual meetings if you'd like to review your individual situation. We can help by running estimates for your pension, reviewing your survivor benefit options, helping you decide when is the best time to take your pension, discussing supplemental accounts like 403Bs, IRAs, and Roth IRAs, and also looking at how Social Security is going to coordinate with your CalSTRS or CalPERS pension. So we look forward to being a continued resource for all of you, and on behalf of our team and also on behalf of Security Benefit, our sponsor today, I want to thank you all for attending and also thank you all for the hard work that you guys have been doing in our school districts. it means a lot to everyone. So have a great week and hope to see you all around.